Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi everyone, welcome to an extra special episode of Facts versus Feelings, episode 129 of Facts versus Feelings. So I was out on spring break last week, halfway across the world in Turkey, which is an amazing place to visit with my family, I should say, but also because there was so much of stuff happening there right now with politics and markets and things like that, the currency, the stock market and interest rates, things like that. But maybe we'll talk about that in next week's episode when Ryan's back. Ryan's on a well-deserved spring break right now, hiking the canyons in Utah, I believe. He's probably sleeping as I speak. But so anyway, that's why he couldn't join me. But last month, on March 19th, we celebrated Women's History Month with an extra special Facts versus Feelings live stream. We had four amazing leaders in the financial industry joining Ryan and me to talk about the economy, markets, both public and private markets, portfolios, and even how to think about taxes when investing, which all of us, I think, care about here. So last week's Facts versus Feelings episode, which is episode 128, we had Lindsay Bell, Chief Market Strategist at Clearnomics, and Carson's own Chief Tax Strategist, Debbie Taylor, on. I definitely recommend that one if you haven't caught it already. This week on episode 129, we have our other two guests, Jessica Menton, Senior Equities Reporter at Bloomberg, and a good friend of the show, and for Ryan and myself too. She writes a lot about what's happening in markets, and part of that, involves talking to people across Wall Street and beyond, everywhere, right? Investors across the board to see how they're thinking about markets and positioning their portfolios. So there's a great conversation about what's happening in markets right now, especially given all the volatility we've seen, and some inside baseball as to how she goes about her job too. Then we also had our own Kate Hall, who's a teammate here at Carson Investment Research for Ryan and myself. She is also vice president here at Carson and leads our alternative due diligence. She is amazingly knowledgeable about private markets, how they work, why you should consider investing in private markets, how they diversify portfolios, and most importantly, what goes into selecting good managers on the private side, where you can't really go invest in something like the S&P 500 with an ETF, right? So I think you'll learn a lot from our conversation with Kate. But before I move to that, really quick note on markets as well. Obviously, we've had a lot of volatility recently, and it's not entirely surprising. Even going by history, right? Late February, March tend to be a bit of a banana peel period for markets. Ryan's done some really cool work on this. We've talked about this for the last month or so, right? How this period could be tough in terms of volatility. Now, the drivers and causes of these sell-offs in February, March, historically, are always different. This time it's tariffs. And let's be clear, look, the tariffs that are being proposed are quite massive. It's quite significant, right? I don't want to minimize that. But while a lot of people are still worried about uncertainty, whether we'll get the tariffs or not, our thinking is that, look, tariffs are here. And tariffs are likely not going away. Now we have to deal with the ramifications of that. We're still in the camp that the economy will avoid a recession. For now, we're not seeing a big drop in the hard data, even though the soft data, just sentiment, that's been terrible. The labor market is okay. Hiring could be stronger, but the unemployment rate is still on the lower side because layoffs are low. Despite all the headlines about layoffs and cuts, initial claims for unemployment benefits, that's not spiking. And that's why you'd see the impact of layoffs, right? That would be a leading indicator for the economy. So far, so good there. It doesn't mean things are perfect. It just means, look, we're in a slower growth environment instead of, say, 3% GDP growth that a lot of people were expecting back in January, not us. We're probably looking at something closer to 1.5%, 2% for 2025 right now, maybe slightly lower too, given headwinds from tariffs, things like that. But there's still tax policy to come. I think a lot of people are not talking about that just quite yet because Congress has to get their act together. But I think they will because there's a deadline that they have to get the tax issues sorted out before the December 31st, 2025. Q1 was tough for markets. The S&P 500 fell more than 4%. It's off about 9% from its February 19th high. But the sell-off wasn't that broad, and diversification, even across equities, right? That would have helped. 7 out of 11 sectors were actually in the green in the first quarter. International stocks also outperformed. Ryan's got a great blog up on carsoninvestment.com/research, so take a look at that. The MSCI All-Cap World Index, excluding the US, rose over 4.5% in the first quarter. That performance differential between international markets and the US was over 9%. That is the largest difference since the second quarter of 2009. The dollar also pulled back, and that's not what you usually see if this was a massive risk-off scenario, right? If this was a big, scary scenario where everything's down, that wasn't the case. And the dollar going down is also a tailwind for international stocks. Gold had a big Q1. Bonds also gained because yields fell. So diversification sort of worked. And what happened in the first quarter is probably a good reminder that you don't want your portfolio concentrated in any particular area of the market, especially when there's some turbulence, right? So I think there was a good lesson in portfolio construction right there. And you see the benefits of that, in the first quarter. Look, Ryan and I are going to spend a lot more time talking about this when we are both back on our regular schedule next week. But for now, here's Jessica Menton from Bloomberg for about the first 25 minutes, and then our conversation with Kate on private markets and everything around our Carson Investment Research team after that. So enjoy listening. Thank you.
Jess Menton, apologies. I guess you're live from Bloomberg, right? Which room are you in there? Have I been in that room? Where are you?
So I'm not at my desk right now. We have a lot of fancy rooms, but I couldn't figure out how to get this to zoom in any closer, so I look a little far away, but hopefully you can hear me, so it all works out.
Yeah, and we see some Bloomberg stuff. There's my office in the background, too.
In case we didn't believe you really...
colors.
In case we didn't believe you really worked at Bloomberg, it's really there. This is neat. So Jess, we're excited. We've already had conversations about the markets. We talk about taxes, and I love what you do. You talk about markets, but also you live in the world of media, and I do a lot of media, and Sonu does a lot of media. So I thought this would be a really fun conversation for the next 25 minutes or so. But let's just start. We live in a world of compliance. We like titles and things. What's your title over at Bloomberg, and what kind of do you do all day? Because I know you do a ton, but what do you do all day?
So I do have a few different roles. So I'm the deputy team leader for the U.S. equities team. And so that basically means I'm helping manage the coverage that comes off the U.S. stocks desk. And then I'm also a senior reporter for the same team. So that means I'm also doing more of the enterprise, kind of big feature reporting, sort of the bigger takeaways from what's happening when you connect the dots across the equity market, whether you're looking at obviously technicals, like I know you watch very closely, Ryan, as well as positioning, derivatives, what's going on with macro, micro, and then pretty much everything in between, and then basically telling kind of these are the bigger stories of the week, as well as when we get toward the end of the quarter or annually. So it kind of just depends on the size and scope. And obviously, there's always big moments in the market, but clearly we're at a crucial inflection point right now.
No, I'm curious. I see the Bloomberg Terminal keyboard in front of you.
Yeah.
Yes.
What was the last chart you looked at? I'm sure the Bloomberg Terminal, it's in front of you.
So so we're lucky as reporters. We have this G function where we can go and save a lot of our charts, and I can go and kind of quickly and update different things. I was actually just looking at the cost of hedging for the SPY. So obviously the ETF that tracks the S&P 500. And so that can tell you a lot of like the hedging demand, like how many, and you can do it on different time frames. So you can do it a month out, 2 months out, 3 months out. But what's interesting about that, even though we saw it spike a bit, obviously once we came off of the highs for the S&P 500 a few weeks ago on February 19th, and after we saw a number of the sell-offs, you saw the cost of hedging climbing, but still now it's come down a little bit. So it's not nearly as much as it would have been, say, right after the December meeting for the Federal Reserve. That was on December 18th. And then obviously when the yen carry trade was unwinding in early August. So you're seeing the cost of hedging come in a bit. And a lot of that just has to do whenever I'm talking to sources like Danny Kirsch over at Piper, as well as other people who work in the derivative space. A lot of their clients were already degrossing and had hedges on before what happened with the correction. So that's why you're not really seeing a spike in that yet, as well as the VIX, of course. It's closer to 20 now, but intraday trading earlier this month, we saw it get closer to 30. And usually when I'm talking to people in the derivative space, it gets more costly to put on puts or protection above that. And so sometimes 30 can be that kind of line in the sand and a bit of a ceiling there.
No, love it. I just realized I'm on Bloomberg Radio in a couple hours to close today. So it's a small
Carol
world.
And Tim.
Carol and Tim. Exactly. Carol and Tim. So shout out to them. Always enjoy there. So, I love the idea. We'll talk markets too. We've got time, but I love the idea of careers, right? I know you and I met, I guess I met you. Was it USA Today, right? That's where you were?
So actually, I think we met even before that was at the Wall Street Journal, right? So I worked at the International Business Times. I was covering equities, markets, macro. I pretty much always covered equities, macro, and everything in between. And then I was at the Wall Street Journal for a long time. Then I was at USA Today, did the same role.
Got it.
And then you get recruited to come to Bloomberg. So it all worked out. But so we've known each other for probably at least 10 years.
It's been a minute, but I always enjoy getting to talk with you and everything you've done to help kind of my career. And I love chatting with you on markets. So that's great. Now with Bloomberg, you do some radio, you do some TV, you do some writing. I mean, it feels like you're everywhere, which is awesome. For someone just from a media point of view, is that normal to do everything like that? Because it feels like you're everywhere, which I'm really proud of you when I see you all over the place.
Well, thank you. A lot of it has to do because underneath the Bloomberg umbrella, there are so many different platforms. So predominantly, I'm a print reporter and I'm writing, but because you also have Bloomberg TV under this umbrella and this radio, it's literally on the same floor that I work on. So I can just kind of run over. And you were mentioning Carol Massar, Tim Stenovic, who you're going to be on Bloomberg Radio on Bloomberg Business Week later this afternoon. But there's a lot of times if they're on vacation, they'll pull me in to fill it for them. Or a lot of times, like tomorrow morning, for instance, I have a weekly hit with Tom Keene that I'll do on Thursday mornings. And then occasionally I'll step in and anchor with him if Paul Sweeney's gone. I think I'm with him with Tom Keene next Friday too. So it's fun because I get to, they really bring me in because they value the reporting that I'm doing and the writing and the conversations I'm having, whether it's with hedge fund managers, people that are maybe on the retail side, portfolio managers, and then strategists, and then anything going on with derivatives and technicals. They really want to hear about what are my conversations like, what are people, how are they positioning specifically, because it kind of can help them get some insight into what's going on in the equity markets.
I was looking at a recent piece that you did, maybe the last piece you did, unless it's a new one today. You were writing about profits, and profits are what ultimately matter to markets, right? We're talking about, market volatility and tariffs and things like that. How much is the profit outlook changing, and if so, by how much? And I'm just out of curiosity, how much is it being impacted by, say, tariffs?
What's interesting about this, and I know that y'all cover this so closely too, and of course, Gina Martin Adams, as Ryan knows very well too, she's on the CMT Association board, and she heads up our sell-side research at Bloomberg Intelligence. And so her team, along with Michael Casper, Wendy Song, they monitor this very closely. So what they do on the Bloomberg Intelligence dashboard, so anyone who uses the terminal can go in like BI Go and go to equities and see what they're looking at. But basically, they pull in the sell-side consensus estimates. And what's interesting about this, despite what's been going on the last few weeks when the S&P 500 was briefly in a correction, obviously the NASDAQ 100 is still in a correction. But if you look at the profit outlook for 2025 as well as 2026, it's still very strong. So it's coming just slightly for this year. It's around 10% growth compared to 13% at the start of the year. But typically investors are looking further out, right? So they're looking to 2026, and that's still at 14%. That's unchanged from what we would have been at the start of the year. What's interesting is the point we're at, because we already got past fourth quarter earnings season for the most part, and at 14% earnings growth year over year for that period. I mean, that was the best quarterly stretch since the final 3 months of 2021. And obviously that was the time period where the world was starting to reopen and we saw some massive profit growth when people, especially companies, were hoarding those cash hoards and putting it back through buybacks and things like that. So what we were looking at more closely was earnings estimate revisions, because that can give you a little bit more of a real-time estimate of as far as what sell side was looking 12 months out for EPS growth. So they've been marking them down for about 22 of the last 23 weeks. But of course, we still have, earnings season really doesn't kick off until April 11th when JP Morgan reports, as well as other banks. And a lot of things could happen between now and then, as well as, you have that April 2nd reciprocal tariff deadline. And I think a lot of, on the sell side strategists, they can't really move the needle a lot. And a lot of companies, even though we saw Delta bring down some of their earnings forecasts, I think a lot of companies, especially different industries, are affected in different ways. Like the Mag 7, for instance, a lot of them don't have that exposure towards Canada or Mexico. It's more so when you're looking at in Asia or China specifically. But then if you're an automaker like Stellantis, you have plants in Mexico that could be more impacted. So I think a lot of these companies are really waiting toward after that deadline to figure out how to guide lower. But then you could also see the song and dance where companies move those estimates and lower the bar to more more easily beat those expectations.
Right.
So it's a bit of a conundrum, right?
If they were going to use this as an opportunity for a little bit of sandbagging.
Yeah. And anyone who may have underestimated those types of impacts, a lot of whether they're portfolio managers or other strategists, they're saying, well, if something happens like that and companies end up needing to guide lower ahead of before they put their results out, you could easily see them do that. And then once the reports actually do come out in a couple of months, then you'll see the stock higher, even though you might initially see that lower. So it might not be as, in 2018, even though the height of what was going on with the trade war, there were massive buybacks because of the tax overhaul that got passed at the end of 2017. And then, of course, there was that big sell-off in the final quarter of 2018, especially that December. But it was just a very different Fed and a different cycle when it came to hiking compared to what the economy was doing. And really, you didn't see it show up in earnings growth until a year later. So you saw close to 15% year-over-year earnings growth for the S&P 500 in 2018. It was a little over 1% in 2019. So this could take multiple quarters, but then also the economy is much stronger right now than coming out of COVID than it was during that time. So that's another struggle to where you might still see earnings estimates be more robust than people would be assuming.
Oh, that was great. Again, this is a live stream of Facts versus Feelings with Ryan and Sonu. It is Women's History Month, building community for women in finance. Again, joining by Jess Menton over at Bloomberg. So I know you and I were kicking around the idea of Wednesday being strong. I know you wanted to maybe point it out. I've been talking about it a lot. For whatever reason, Wednesday is wildly strong. And then the problem it's the other 4 days, although we had a pretty strong Friday and Monday recently. Why in the world, you talk to a lot of smart people, not that I'm one of them because I really don't know why, but why in the world is Wednesday so strong this year?
You know, it's funny because I saw y'all had put out kind of this annual outlook that you were looking at for key charts, but this chart wasn't in there. This was something else I noticed that I had covered in recent years because it was the opposite. So sometimes you see things change whenever the markets are more volatile. But what I thought was interesting, because last year you typically saw the dip buying Mondays and Fridays, and now it's the opposite. It's on Wednesdays, to your point. And a lot of that has to do with a lot of traders didn't want to go long into the weekend. So whether it was tariff-related news out of Washington or say DeepSeek that we saw toward the end of January. So you had kind of a multiplier of different events that were going on to where you're starting to see that just happen more so on Wednesdays, maybe even Tuesdays sometimes as well, or Thursdays. And you're even seeing it more stark when it comes to more of the retail traders, because I know a lot of people like to use that as contrarian indicators if you're looking at what are hedge funds doing, institutions versus what retail's doing. And you're still seeing strong buying in retail right now, whereas hedge funds were the ones that were dumping coming into this year. And especially stocks like Tesla, a lot of retail traders are still going in and buying that on the dips.
Ryan does so much of great work on seasonality. And my pet theory, I don't even know if this is true, for why seasonality exists. A lot of it, I started my career in the options market, so there's a little bit of bias there. Options modeling, volatility modeling, basically. And my pet theory with seasonality is a lot of it has to do with options, even things like never shorting dull markets, or the strong seasonality from, say, November to January because of all the holidays and option time needing to catch up with calendar time. I won't get into any more details beyond that, right? But I'm curious, I know you look at this stuff, and how much do the options market drive activity or movements in the overall market, like the S&P 500, for example?
I think it can be crucial, especially with positioning and where we're at the calendar. I know that Ryan watches very closely the presidential cycle, and typically the quarter that we're in now, coming off of the election year, you do tend to see some weakness just because you do tend to see historical, especially the last 2 months of a year, once there's certainty about who's coming into office, and as well as what gridlock or not gridlock will look like in Congress. And so you saw a similar dynamic over the last, especially since the U.S. election in November, but specifically when it comes to the options space, we'll have triple witching this Friday. Of course, it's been one of those things the last few years where sometimes people will make a big deal out of it, but then right, it's triple witching. So when you look at the expiration when it comes to specific single stocks, indexes, as well as ETFs, but sometimes you don't really see a lot of movement on the headline surface for an index. It's more micro and specific stocks related, as well as companies that'll be added to the S&P 500 before trading next Monday. So DoorDash is one of those, as well as Williams Sonoma. So you'll see a few things like that, but then also sometimes people will point to triple witching, but then when it doesn't end up being a big event, it's usually a reason if there is a lot of volatility, but then if there's not, people will say, well, that wasn't anything. But something specifically I would say toward the end of every quarter is the JP Morgan collar trade. So the ticker symbol on that is JHEQX for those on the terminal or where else they want to look at. And the reason I bring that up is because basically JP Morgan has this basket of stocks in the S&P 500 with options on the index, and it also resets and hedges once a quarter. So it'll be March 31st. That'll be a Monday this year. So the closer we get to that
everybody knows when that is, right?
Right, exactly. And the reason I bring it up is because there is typically strike prices that are at the call level, which we've been paying more attention to over the last few quarters just because of the nonstop rally the last 2 years in the S&P 500. But then there's a put price. And I did a story about this last week because 55.65 was the put level for this particular trade when you're looking at the collar trade for JP Morgan. And usually during intraday a few times last week, like Monday and Tuesday, for instance, you'd see the S&P 500 briefly break below that, then trade back above. And the reason is the closer it is to those levels, like say if you are basically you have to stay neutral as like an options dealer, you might be forced to have to step in and then start buying. Whereas like if you get too far below that price on the S&P 500, like we would have seen maybe on Thursday or the middle of last week, then you see kind of the S&P exacerbated lower, closer to 5,500, but there's not a ton of puts below the 5,500 level. So it's almost like it kind of served as a floor in a way, but those levels might be more crucial the closer we get to March 31st. But that's something that's come up. Because of course I know Ryan watches the technicals very closely as well, but from the options side of it, there's also other levels there too that options dealers are watching pretty closely. So that 55.65 level has been important.
Explains why round numbers tend to be important too. Which always seems weird. Like, why should a round number be important? But that's where some of these strike prices are for the options market. And just to clarify, this is for compliance reasons. Any of the tickers just mentioned or any of us mentioned, this is not a recommendation to buy or sell any of the stuff. So
more educational.
Right.
So I love the media aspect of this because that's why I want to pick your brain a little bit. Working in the media like you have for most of your career, I assume, who are some mentors and maybe some on-camera personality at Bloomberg that's just kind of funny off the camera if you feel like sharing something? Just some stories here on who you learned from over the years.
Yeah, I've been lucky that I've had a lot of good mentors over the years. I think specifically during my time at Bloomberg, because since I cover technicals pretty closely, I go to a lot of the CMT Association events that Ryan frequents as well. Yep. And so I feel like Gina Martin Adams has always been a really good resource. I feel like because she's a CFA as well as a CMT, she's very good and probably one of the best to do it when you start threading together what's happening on both sides as far as her team and what they're watching. And then also on the media side, I would have to say Carol Masser, Tim Stenovic, as well as Alex Steele, and a number of others on the media side who've, anytime I have any questions, and of course, you can't forget Tom Keene, right, who's been here for decades, and and Paul Sweeney as well. So anytime I've been able to anchor with them, co-host anything, they're always they want to hear about what I'm reporting on, but then they've done this for decades, so I'm always able to pick their brain and get any advice. So I always feel like, especially Tom Keene in the mornings, it's funny because before we'll anchor together, he always tells me, let's just have fun. So he obviously values and he wants people to be sharp with the market knowledge, but he also wants people, and especially the audience, to have a good time and really take something away and learn something from what we're talking about.
Tom's obviously a legend. I think one of my first like live interviews was with Pim Fox, probably 20 years ago. Pim's not at Bloomberg anymore, right? Or is he? Or no? No,
he went over to Fox, and I think he might still be there. I'm not 100% sure, but he was a big fixture here at Bloomberg for a long time.
Oh yeah, we were going up the floor 6 and being so nervous and worried, not worried, but just nervous. And then like I'm literally on TV yesterday, and I wear this St. Patrick's Day hat on TV. It's like I'm almost too relaxed now. It's the fine line there. So go ahead, Sonu, jump in.
No, it's like we like to have fun.
We like to have fun.
The market's a serious business. I mean, at some point you try to tell yourself, don't take yourself too seriously here, or you get
right.
But actually, I'm looking at my screens and I see green on the screen, which is nice and pleasant to see after the bout of volatility we've had. And our people, let's talk sentiment. Sentiment's shifted, up and down a lot, right? Right now, I think it's generally negative. But are people you talk to, are they buying the dip here?
So retail traders tend to still be doing it, maybe not as aggressively as they were at the start of the year, but because we've talked about the AAII survey so much in the past, and I know that y'all watch this very closely, especially the bull-bear spread. A number of weeks now, it's been an excessive negative territory, especially even beyond if you were looking at the date since 2022. If you pull it back even further, it's kind of astounding. It's almost like at levels since 2009, which both of those in 2022 and 2009 kind of corresponded with lows in the S&P 500, but also something beyond that. I always look at the fund manager survey from Bank of America that comes out in the middle of each month. So what was interesting to me, and we got a sense of this yesterday. So Michael Hartnett from Bank of America puts this out, and he's one of their chief strategists there. So investors were cutting their holdings of U.S. equities by the most on record. And then also the cash levels, they had the biggest jump in cash allocation since March of 2020. So obviously during the height of COVID, and a lot of times those can be more contrarian indicators. You saw cash levels around highs, say back when the S&P 500 was making its lows for the bull market, or the bear market rather, in the fall of 2022 before the bull run over the last 2 years began. So we're starting to see different signals where they're reaching extremes, but a lot of either technicians or people in the option space, and I'm sure y'all can weigh in on it as well, as far as certain signals stacking up, but like it's almost like the conditions made sense to see a bounce back, but they're not necessarily seeing all of the signals just yet. But I would point out that Goldman Sachs, they get CTA data. So basically these are commodity traders that trading advisors. So basically they look at the underlying markets and they look at the momentum. And basically Brian Garrett, who's over at Goldman Sachs, was telling some of his clients that basically the selling was so far advanced that the shift would be more focused to the upside, but you'd have to see a bigger day there. So that's a corner of the market that I'm keeping an eye on to see whether or not they end up stepping up their buying just because we saw such a stark drawdown in the S&P.
Well, I'll say this. I'm a huge fan of Ed Yardeni, right? Also Tom Lee, for that matter. I remember Tom Lee in March of, 2 years ago, March of 23, got pretty defensive, right? There's always bullish Tom Lee, and he wasn't necessarily then. And Yardeni just cut his forecast into Trump put his kaput. I'm thinking to myself, wow, if some of the biggest bulls are kind of saying, I'm not so sure. Maybe that's the flush out. That's one, as anecdotal, I get it, but that's something that's caught my attention. We are doing this before the Fed. And this people listen to it live, obviously live. People listen to it exactly 1 week from now. So let's just put a big asterisk on there. We don't know what the Fed's going to do, but you obviously follow the Fed closely. How have you thought the Fed's been doing? What's your take on the Fed and what you've heard from people out there?
Well, basically, so I covered obviously Powell during President Trump's first term, as well during that trade war and what was going on with the tax overhaul. I would say specifically for more today, when it comes to those dot plots, since they're quarterly, the median projection during the December, because that's the last time we got the dot plots, was around 3.9 for the end of this year. So obviously they're looking to see how that potentially could adjust, whether or not growth forecasts move lower and the inflation forecasts move higher. But a lot of my sources are thinking that Powell could come back and hedge that, saying, hey, if this is adjusted somehow, this could be adjusted again, depending on how the economy moves. But then beyond even just the rate cutting picture, they're looking at what they're going to signal about the balance sheet, because that's always a big story that goes on in the background that sometimes people might overlook here. And that was something in 2018, especially at the end of 2018, they were paring back the balance sheet, and then they ended up stopping just because of what was going on with the liquidity in the markets and the sell-off. So that's something my sources are watching to hear. What exactly is Powell going to say more about that balance sheet runoff in addition to rate cuts?
Do you think they move in a little bit of and I want to be careful here, because when I say the word, in a stagflationary direction as opposed to predicting stagflation, by moving their growth expectations lower and the inflation expectations higher?
I think that would be, a lot of people may take that when you first get the dots right at 2 o'clock, but I think that's why a lot of it hinges at 2:30, what he ends up saying about his rhetoric, because I think he will use that as a way to explain how they're viewing where the economy is at this point. But then, of course, he always stays pretty tight-lipped and basically emphasizes how the Fed's going to be data dependent. And I would point out too, because I know Ryan was talking about when you're looking at more on the sell side research and what the perma bulls are doing versus the perma bears. I mean, Ed Yardeni, of course, he brought down that target for this year from 7,000 to 6,400. Right. But even I talked to Jeremy Siegel, who's a well-known buy the dip kind of stock bull, and I mean, he would still argue for buying the dip, but I talked to him a few weeks ago before we were in a correction, and he was already kind of calling for a 10% correction as well. So that's rare that you would hear somebody like himself say that too.
Just speaking for our models, I mean, but you'd mentioned like managers that degrossed maybe even before this. We'd done the same thing on our side. Not necessarily we kept our equity overweight, but we moved into more like low volatility stocks. We reduced some high beta stuff in the portfolio. So, but I was curious about, what you're hearing from all these different parts of the market and market actors and investors. It doesn't seem like the signals are clear, whether you want to be more bearish or whether you want to be much more bullish, right? Either way, it's like all the signals really haven't lined up on either side.
They haven't. What's interesting, since the S&P made that more recent low on March 13th, you're seeing the more riskier corners of the market taking off. So like non-profitable tech up nearly 8% since then, the Russell 2000 at more than 3% in that span. Most shorted stocks also up close to 4%. And then obviously in that span, the S&P 500 is only up around close to 2%. So, but it would make sense because those were the more beaten down names. So if you zoom out and see how much they got pummeled, you're starting to see that more risk on in the near term. Whether or not that holds after Powell speaks remains to be seen. So we'll have to wait and see if the more riskier corners pick up even more so or not after he speaks.
Well, that was great. What do you have going on this afternoon with the Powell stuff? You on TV, on radio, writing? What do you do to help the industry?
I'll be writing. Usually you don't see me on Fed days on radio, TV because I'm typing away. So then I'll be doing all that, and then I'll figure out. I will be on with Tom King tomorrow morning at either 8:50 or 9:50. It remains to be seen, depending on how the lineup's going to work with the show. But I'll be busy typing today.
Well, that's great. We've got like about a minute and a half to go here. I know you've got a hard schedule. We do as well. Jess, we're honored that you took some time to speak with us here at this special live stream to honor Women's History Month. I called you Jeff to start it. Obviously, sorry. I still feel bad. But, like going out, let's have a fun one. You're on air a lot, and you've heard rumors or you've seen people on air. What's like one of the biggest mistakes maybe you've made on air? This, not the end of the world, but you call someone Jeff and the name is Jess. Have you done anything like that where you put your foot in your mouth? Because trust me, we have a podcast. We've done 127 of these. I do it every week, so I'm not judging. Any funny story here on air?
Oh man, I'm trying to think of a more recent one on Bloomberg or not. Luckily, not at Bloomberg yet. I'm trying to think of some stuff I did when I was younger. But I think everyone does it, right? Like it's more of like just how you move on. You make any sort of blunder. So I feel like it's the recovery matters a lot more, because even the best of the best, right? Like I see them sometimes stumble just because they've been on air for a long time. So I think you just got to keep going. And so don't worry, I don't take offense for being called Jeff. So a lot of people call me Jen on accident. It happens. Yeah.
And whoever Jess Menton is, I'm sure there's one out there. Hello, how you doing, Jess Menton?
We should connect.
Anyway, there we go. Well, Jess Menton over at Bloomberg, thank you so much for joining us. I think we've hit the end of our 25 minutes here. This was awesome. Thank you for everything you do in our industry and all the amazing work. I always love reading your name and seeing you all over the place. It's makes me feel good to see that good things happen to good people, and just keep doing your thing. And if the Carson team can help, we're here for you. So with all of that, thank you, Jess. Last but certainly not least, Kate Hall. There's a great commercial there with Kelsey. Thanks, Tori and the team for putting that together. I do want to also say, as we're winding down, thank you to Tori, our producer, for making sure we stay on task with all. Sonu and I just talk. We never pay attention to what's going on. We just talk. A lot of hard work that goes into all of this, and it's not lost on us. So thank you. So Kate Hall on our team is here.
Yeah,
Kate,
one of my favorite people in finance.
We like titles around here. Give us your title, Kate, and a little bit about what you do to help the Carson community.
Sure. So I'm Kate Hall. By the way, thank you for having me today. This is a great honor to be on the show. So I'm the Vice President of Alternative Due Diligence for the firm, and my main role is to I've built the platform of options for our advisors across, the various flavors of private investments, maybe some alternatives at some point. We'll get into that in a bit. But I do all of the kind of hiring decisions, bring them to the committee for vote. We did one this morning. And I do all the ongoing analysis to make sure that the opportunities that we have on the platform are performing as we hope they would, and that things are, all on the up and up.
I put like this, I would say Kate's popular because people reach out to me because they see me out there and say, hey, you want to do something with alts? I don't know. Go talk to Kate. I don't have an opinion here. I don't even know what you're talking about. So, let's start there, Kate. When someone hears the word alts, I'm not saying it means something different to everybody, but when you hear alts, what does it mean to you, and how do you describe that kind of to somebody who honestly listens to this podcast? We haven't really talked about alts all that often, at least as specific as we're going to today. So what does that mean?
And I'll piggyback on that.
Yeah,
while you answer the what do you think people hear when they hear the word alts, and what do you think they should hear if they follow you?
All great questions. Alts at this point is a very generic term, and I'll get into why. But I think that
alternatives, by the way. So.
Yeah, I think that folks who are not necessarily educated on the space think scary. They think long-term capital. They think I'm going to lose all my money. They think illiquidity, lack of transparency, all these kinds of things. And when I think about alternatives, I think about anything other than stocks and bonds, things that provide opportunities that provide portfolios with different sources of return. And so in that capacity, I really focus on the private side of alternatives, which is private credit, private real estate, and private equity. Alternatives also encompass things like hedge funds and different types of trading strategies and merger arb and long short equity and things like that, which are also considered alternatives. And then even things like commodities, managed futures, et cetera, those are alternatives as well because they provide a different source of return in client portfolios. But what I really think about when I hear the word alternatives and private investments are fun due diligence projects. Nobody likes a fun, complex due diligence project like I do. It's a great way to utilize a process that I developed a long time ago and, put some new inputs into it and hopefully come up with a good answer.
No, I think that's great. You made a nice distinction there, I think, between alternatives and privates. Right? Like usually when you think alternatives, like gold can be an alternative. And like
sure.
Brian and I, we manage Carson Housing models along with Barry and Grant, and you have gold in the portfolios, and that's a publicly available ETF, right? I will mention.
Right.
Whereas alternatives, technically, when I think about it, I think of stuff that doesn't zig or zag. You don't know what direction they're going to do, what they're going to do, depending on what stocks and bonds do. Like, not that we can completely predict what that is, but they're non-correlated assets. But a lot of your focus is on the private side of it, right? Where there may be additional opportunities to diversify portfolios, both from the side of returns, but also risk, right?
Oh, definitely. So in terms of diversification from those three big buckets, if you think about private equity, you're getting return sources from things that may happen, like the company being sold, which is going public, which at this point is not happening as much because the IPO market is somewhat closed. Within private credit, you're getting return streams from typically floating rate loans, so that's a different source of return relative to traditional fixed income. And then with real estate, it's sort of a hybrid of both income from rents that are charged and capital appreciation of the underlying assets, whatever that may be, multifamily, industrial, data centers, what have you.
Right. And on the private equity side, I mean, I think generally when private equity is a very large umbrella there.
Yes.
There's different things under it. Like maybe just to, again, none of this is simple, but if you can simplify, what's the difference, just say, between venture and private equity?
So venture is a sub asset class of private equity. It's the earliest stage. It's right ahead of giving, friends and fools who give money to early stage venture, right? That the types of venture that we're in are sort of the later stage that are about to, move into the earlier stages of private equity. So yeah, they are the same. Some other they're one and the same. Some other distinctions that you might make is, there are private equity investments that are in, long lock vehicles where you put your money in for 10 years and you may not see any distribution during that period. You're probably going to see depressed returns at the beginning as the manager moves through the J curve cycle. And typically very large minimums, and suitability is for clients who have at least 5 million in investable assets. This is compared to we're seeing a proliferation of semi-liquid investments that clients can invest in across all of the privates. And in those strategies, you have a semi-liquid situation where the potential is to take out 5% every quarter. But those strategies, I call them private equity light, because they're typically invested in things like secondaries. So it's not like going into the type of fund that I just described with a long lock. You're getting into it's basically a great opportunity at this point, because you can get into private equity investments that need their LPs and GPs that need liquidity. And with the IPO market basically shut, and now with the new administration making things a little more difficult, this is a great way to get exposure to the asset class at potentially a discount. The discounts are slim, but what's really great to see is that the returns that you're getting out of the secondaries are really generated by rolling up your sleeves and generating growth and cash flow, capital appreciation, versus just getting a return that feels kind of like, did I really get this just because of a secondary markup?
So that's interesting. I mean, I'm learning a lot just listening here. This is great. What are some of the risks, though? Like, I've always heard, and again, this is what I've heard. Sometimes you want your money back, you can't get your money back as soon. Liquidity can be a risk. What are some of the risks when we talk about privates?
So a lot of people focus on illiquidity, and there's a blessing and a curse with that.
Okay.
The curse is that with clients who may not be prepared for having their money locked up, it's scary, right? You may have an unexpected event come up and you need the cash, which you're probably not going to get. The blessing is that that managers have time to execute their strategy. They have confidence that they're going to have capital in their strategy to do what they need to do. And so, from that standpoint, illiquidity is a good thing. It's also a good thing if you are in a fund where you have a mindset that is longer term and you are comfortable with the strategy. And let's say we saw this happen a couple of years ago with one of the real estate funds that I won't mention. And there were a bunch of redemptions all at the same time. Mm-hmm. If you're not ready to exit that strategy, and your neighbor is ready to exit that strategy, your investment may be adversely affected by folks who want to get out for whatever reason. And so you want to be invested with people with a like mindset to keep their capital invested for the long term, not get scared because of one reason or another and want to redeem.
So it's safe to say this is probably isn't for everyone then. You kind of mentioned like-minded people. Is this for everyone, you think?
I think it's so. I think clearly there are suitability issues or requirements to get into alternatives. So that's sort of the low bar. I think if you have a long-term, medium to long-term mindset for how you want to allocate your portfolio, and you are well educated by your advisor about what you're buying, these are great, they're nice diversifiers for a public market portfolio that's going to have more gyrations in I call it the statement reading experience. You're going to have a little bit easier time with a lot of, private market stuff on a shorter term basis. And we can get into the valuations and other risk. You need to really understand how your positions are being marked.
Like on a public, if you invested in public equity markets or even ETFs, whatever, you can look at a screen and see what the valuation is. What is the net asset value? What's the price, right? Private markets, you can't see that. That's what you mean, right?
Right. Well, so with the semi-liquid strategies, you can see, more timely valuation marks than if you're in a lockup LP kind of structure. But I think we're seeing this year, obviously the markets have been very volatile, and having having some diversification in your portfolio clearly has helped returns. But private markets are not the end all and be all. Like portfolio, there is a place for public and private diversification and roles that the client should have exposure to.
At the margin, do you think it improves? I say this very cautiously, improves investor behavior, because if you're assuming everyone's on the same page with respect to who's investing in a particular alternative fund or vehicle, whatever it is, but it is a long-term investments. And when Ryan and I are always talking to advisors, clients, even like, yes, your investments tend to be long-term. Don't act based on what markets are doing today or tomorrow. And I think about like private markets, you don't see it. So maybe I don't know. I'd love to get your perspective. Does that make you at the margin a better investor because it's long-term, you already accepted it, you're not going to pull your money out, maybe because you cannot pull your money out?
Right. I mean, that's kind of also part of the blessing of illiquidity. You can't make those knee-jerk reactions, right? And so, like, if you know that, even if you put yourself into a 10-year lock with maybe a 2 or 3 or 5 year extension, you may be allocating that capital for your heirs. Okay, mm-hmm. So you don't care about the interim volatility, or it may be an investor who has run his or her own business, and they understand, they're not interested in the public market, gyrations and reporting and such. Like they've done this themselves, so they're comfortable with lockups.
Right, and a large part of what you do is education. And like you mentioned, advisors have to educate their clients, but I feel like, a lot of advisors are not familiar with alternatives.
Yep. But
you are, like some of us on the team learn a lot from you as well. And speaking for myself, as every time I talk to you, how big is that education piece? And, what do you, and because of you, Carson, bring to the table in terms of educating our advisors about
the education process is every day, just like it is on the public side. I've been doing this for a long time, and I think this is a great piece of advice for folks who are getting into the business today, is to continue that education process. It's not, and even for advisors, it's not just allocating to a strategy or two and kind of walking away from it. You really need to stay in touch with what's going on, so that you can educate yourself and your clients, because you will get questions. I mean, all investments have bumps along the road, right?
Sure.
And so, keeping up with education, there are all kinds of resources for that. We have the Content Hub at Carson, where I post all kinds of things about the individual strategies and markets, and kind of everything from what are alternatives to how to prepare for a meeting, discussing alternatives, things like that. LinkedIn is actually a really great tool. There are a lot of folks that you can follow with good information. I do it myself. The big managers, Blackstone has one of the best education programs I've seen, that advisors can go through their modules and really learn the basics if they're new to the space.
So you mentioned some managers. I think it seems to me like a decent part of your day can be talking to managers, right? That everybody reaches out and says, we've got the best thing ever. I hear it all the time. Sonu hears it all the time. You almost have to have, hope I can say, like a BS detector, because you've done this for a long time. Yes. How do you know which manager means it? How do you know which manager, maybe there's an issue there? I mean, of course, the Bernie Madoff example, it was a big scam the whole time. How can you kind of read through that, Kate? And what are some clues you've learned that people aren't maybe telling you the truth sometimes?
I've been doing this a long time, and that meter in my head is very sharp.
How are we doing the last 20 minutes in your head? We doing okay on the BS meter last 20
You're doing
minutes?
Okay. You're doing okay.
Okay, good. I say, all right, that's good.
Yeah,
Make me feel better. All right.
So that's a great segue into preparing for meetings. I mean, I go through stacks of paper to prepare for, especially on the private side, and even in the hedge fund world. A lot of times you get an hour to speak with these folks, and so you got to be really prepared, and you have to.
That's not a lot of time, right?
No. It's kind of, yeah. I mean, you can always have follow-up questions and such, but I spend a lot of time putting agendas together, and what are the key questions both before managers are hired and afterwards that need to be addressed. Because the days of sitting in a manager's office all day long are gone, way gone. But in terms of like, I get emails all day long with potential new investments, and you can like, at this point in the semi-liquid space, I really prefer the big guys because they have really talented people. The transparency is better. And, you also want trustworthy people. And I just know when I hear something that sounds ridiculous, or like what I really don't like is the really hard and fast sales pitch. People who talk really fast, like, no, not so much. Like, I don't like, I know what you're trying to say, but just tell me in English and tell me like, slowly.
You don't want to run afoul of Kate Hall's process that way.
In my prior life, I was called a bulldog because one of my other favorite things about this business is coming up with really good questions. And
you do. I've been on calls with you, and I will attest to that. So.
And that's my second piece of advice for the young folks. Never go to a meeting thinking I'll wing it. I'll just get through the meeting. Mm-hmm. You always I probably over prepare too much. But the over prep that I do always ends up being a trick in my back pocket for a call, the next day or the next week or what have you. So you always want to make sure that you've got your facts straight, and you've gone through all the diligence stuff that you need to do and come up with really good questions that are not just like check the box kind of things, but like really trying to, connect the dots and what you're hearing from a manager.
So being over-prepared is not the worst weakness, I think. It reminds me of the Michael Scott in The Office. What's your biggest weakness? Yeah. I care too much. I try too hard. And it means too much to me, something like that. We've got a couple minutes. It's amazing how fast this goes. I do want to talk a little bit about your career and kind of Carson and kind of weave some of this together because you've kind of started hitting at it. What are some ways that you see getting work with financial advisors every day and talk to really smart managers that Carson's kind of opening the door for female advisors, females in the industry? And what are some reasons that you like working at Carson as a female as well? Take that however you want, but I think it's something I think a lot of listeners want to hear.
Sure. I mean, I've been in a man's world, I think, since I was born. I've been doing this my whole life. And I really quickly became comfortable with talking to men significantly older than I am, or at the time older than me. And because I was prepared, and once I opened my mouth, they were like, okay, you're allowed in my office. or having a voice, not just a seat, but a voice at the table. At Carson, one of my first experiences was a dinner meeting on the 6th floor with the crowd of executives up there and an outside manager. I was the only female, and it was a blast. But because they welcomed me as one, I was just one of the people at the table, and I spoke and they listened, and it was great. I think at Carson, it's very welcoming. Maybe it's because of my background, but I don't even think about men versus women. I think about we're all in this together. Yep. And we have a mission to serve our advisors and serve our clients so that they reach their financial goals and dreams and what have you. And so, for me, it's just been a great opportunity.
That's awesome.
Love it.
On that topic of the process, right? And everything you bring to the table, on the public side, a lot of the stuff we do is obviously on the public side. Let's say I want exposure to the S&P 500, easy enough, right? Or to the market, I can go buy an SPY ETF, right? S&P 500 ETF, not a recommendation, by the way, right? But still, right? But on the private side, it's harder, right? I want private equity, but you can't just go get private equity, right? You have to pick and choose and select. And I feel like the most important thing, it's important even on the other side too, it's people, right? You mentioned earlier about transparency and trustworthiness. Yeah, the 2 T's, but people. I feel like
that's the most
important thing, and that's what ultimately your BS detector is, detecting.
So on the BS detector, if you go into a manager meeting and they're struggling, their performance is behind the 8 ball, and they can't really explain to you or won't explain to you why they're having trouble and what they're doing to correct, to change, tweak their process or make it better, learn from the mistake. and admit that the mistake happened, that's a problem. And
is it a problem when like sometimes performance may be too good to be true as well? And
yes, and like digging through performance and really figuring out how it was generated and asking questions like that, you find out what the manager's makeup really is, which is what I spend a lot of time trying to understand what makes people tick. So yeah.
Yeah, no, it seems like the people part is so important, right? I think this is, and I mean, this is a commercial for our team too. I think one thing we do well, obviously, Ryan and I always talk about markets and the calls we make and things like that, right? But across our team, I feel like we have so many of us have done due diligence for such a long time. And one thing that comes out of that, including when you and I talk, right? We talk often enough, and you're telling me about the last meeting you had, and that teaches us, like what good managers do and what bad managers do, and how to, everyone makes mistakes, but you don't want to make big mistakes.
No, exactly.
You do due diligence, you see so much of this happening, and I feel like at the end of the day, it makes us a better investment team all around because of that aspect of it.
Yeah, I mean, all managers.
Yeah,
all managers make mistakes. You just want to see that they admit up to them, learn from them, and move on down the road.
That's well said, Sonu. Our team, we're 15, 16 strong, and we've got a lot of strengths. Of course, there's always some weaknesses, but I think we don't look at it like, oh, this is your job or my job. Our job as a team is to get the job done, make sure our Carson partners are happy, and at the end of the day, keep their clients happy as well. And it's challenging at times. That's just because the market's challenging, but we always have a lot of fun doing it. One thing I was thinking here, like Warren Buffett, okay? If you talk, like most people listen to this Facts versus Feelings podcast, Warren Buffett, oh yeah, he's a stocks guy, he's an icon. Who's like an icon in the private side of things that maybe we've heard of, but I didn't quite realize they're big in your world, Kate?
Well, like the big guys at Blackstone or the big guys at Apollo, like, the big shops are the ones, the guys at Apollo, Blue Owl, the ones that you see in the news are, kind of people that, I mean, definitely Blackstone, is sort of a leader in the private market space. Yeah. And so to me, like they have been really successful in, scoping out trends in investments that they can capitalize on, and that's a really special skill set that not a lot of people have. And they also have, obviously massive resources to execute on what they do. But people like them are, who I definitely pay attention to.
We've got a couple more minutes left with Kate Hall on our team. This is the Women's History Month special live stream of Facts versus Feelings, building community for women in finance. Sonu, we've been doing this for almost 2 hours. Honest to goodness, it's gone really, really fast. I guess one more from you, one more from you, one more from me, and then Kate's off the hot seat.
I'll pick up on exactly what you just said about like the big players, right? With this stuff, everyone's always looking for, I want this niche thing that nobody's found yet and things like that. But because of what we talked about, transparency, trust, education, all of these things being as important as it is to, a space that most people are not familiar with, is bigger better?
Definitely in the private credit space. I think one of the risks out there today, I didn't talk about it earlier, is you're seeing a lot of new entrants come into the space who are not crossing their T's and dotting their I's as they should on the underwriting.
Right.
We will see who's swimming naked at some point. And
there's a Warren Buffett quote. There we go. Yep.
And the big guys who I'd prefer to be with, who have the resources and expertise and balance sheet, will be the players who can scoop up, deals at pennies on the dollar that the guys who don't really know what they're doing are doing today. And so that's one thing that it's a blessing and a curse. It worries me about all of the new guys getting in and gals getting into private credit. Stick with the big guys there.
Yes, guys and gals. Yeah.
And God, I'm sorry. I'm used to being in a guy's world.
No, I thought you said it, and that's why I was just picking up on that.
This was great. This again, Kate Hall on the Carson Investment Research team. I mean, this is hopefully a another example of all the different things that our investment research team does. They kind of see Sonu and I out there and different people, but there's people, really smart people like Kate that have done this for a while that know their stuff to continue to help our Carson partners at the end of the day grow and grow faster than the industry average is what we're trying to do. And that's what we've been doing for a long time. Kate, we've got like, I don't know, 90 seconds or so. So I'll just kind of give you a real nice lob and you can take it however you want. Let's say there's a little girl listening out there. She wants to get into finance and she wants to kind of do something that you're doing. What you already gave some advice, working hard, being over-prepared. What's some other advice you can give for somebody out there who wants to get into the finance world, maybe kind of from the female point of view?
So honestly, I majored in English and Spanish, so I did not have a finance background.
I like tacos. I could say taco. Yeah.
But I think it's really helped me because my strength, I mean, I can do the quantitative stuff to a point, not quite like Sonu, but the qualitative stuff is what can really get you in trouble with hedge funds and private investments, and so that's kind of where my strength is. I would say focusing on that kind of stuff. Obviously, the education, finding a mentor, as Kelsey talked about on the commercial. And guess what? Once you get through being or having a mentor, be a mentor. I love mentoring a person or two on our team. I love like sharing what I know. And then the last piece of advice I would say is always raise the bar. Don't stay stagnant in your work product. Always try and do it better, bigger, maybe not necessarily bigger, but like always, figure out ways to improve and, put out the best product you can each time you work on something.
You do that every day. So
I try really hard.
Oh, that was awesome. If you're listening to the live stream, please don't log off yet. But if you're listening to the weekly podcast of Facts versus Feelings, this was awesome. This entire recent 2 weeks that we've just done and shared some of these Women's History Month podcasts that we've done live stream. This is amazing. Kate, thank you so much for joining us. We really appreciate it. I know our Carson partners appreciate it and their clients appreciate it. Maybe they don't realize it, but the work that you do really does help move the needle to make our team truly, and we're biased, but the best investment research team that's out there. So with all of that, we're going to sign off on the live stream. Get one more guest coming if you're listening to the live stream. But thank you, everybody. Appreciate it. We're going to bring on a special guest right now. Thanks, Kate. Appreciate it. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.